Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, now coming to you on Sunday at noon before the week starts with the stocks to watch and the stock market news you need to see. And Nation, super microcomputer ticker SMCI crashed 33% last Friday on news that two of its employees had run a scheme to smuggle NVIDIA chips into China. I'll give you a full update on shares of SMCI, including a no-holds-barred assessment of management and where to go from here. Beyond that sell-off, the S&P 500 is now down 7% from its January high, and it's not all because of the war in Iran. I'm going to reveal why March Madness isn't just about basketball and how you should be investing right now. We're going to get to that update on shares of Supermicrocomputer next, but first, investors follow a lot of seasonal trends, from the Santa rally to the rule saying sell in May and go away. There is one, though, that hits to the very heart of investor emotions. There's a great lesson that can save you money. Recent analysis by Hulbert Ratings and backed up by research at the University of Pennsylvania around sports sentiment and stock returns shows stocks fall consistently during the March Madness basketball tournament. And this isn't just a one-off event either. In data back to 1982, all four major indexes, that's the S&P 500, the Dow Jones Industrials, Wilshire 5000, and the Nasdaq, all sold off significantly during the 3-week tournament. For example, through March and April as a whole, the Dow Jones Group of 30 stocks returned 6% on average over the 4 decades, but only 2% during the tournament period. Even worse, the tech-heavy Nasdaq closed March and April up 3% on average, but actually fell during the tournament. Now, the research points to investor sentiment and mood around their teams being eliminated. Those investors that see their team booted from the brackets tend to sell their stocks in disappointment, darkening their mood overall. And while it's true there's a winning team for every loser, research didn't find any counterbalance effect, possibly because those winning teams only survived to play another round. Now, the solution isn't to swear off sports. That just ain't gonna happen. And in fact, sports betting hit a record $16.9 billion last year, and is expected even higher this year with the prediction markets exploding. The solution is just not letting your emotions control your money. Unless you're a day trader, that means not jumping to buy or sell a stock as soon as the market opens. Give yourself a few hours to understand any news hitting the stock or the market and for that itchy trigger finger to calm down. It means revisiting your notes and analysis on a stock, why you bought it in the first place, and only then deciding if anything has really changed before you dump it or buy more. I know it's a lot easier said than done, but that emotional part of investing is a big reason why the average investor underperforms the market. In Dalbar's annual survey, the average investor earned a return of less than 3% in the 2 decades to 2020. That's less than half the 7.5% annual return on the S&P 500 market index. Folks, any rules that you can put on yourself, something that just keeps your emotions from clouding your judgment in your stocks, is going to make you a lot of money. We're going to get to that update on Supermicrocomputer next, but if you haven't yet, use the link in the description and check out the free trial on Seeking Alpha Premium. I've used the site for research for more than a decade to check fundamentals on a company, sit in on the earnings report, along with getting the bull and bear case for a stock. Use the link I'll leave in the description or scan the QR code here and try Seeking Alpha Premium risk-free for 7 days. If you like it, that link is also going to get you a $30 coupon off your subscription, so check that out. Now, onto that update for Supermicrocomputer. It took me a couple days because I wanted to make sure I had all the information and put my analysis together. Shares crashed 33% last Friday when the U.S. Attorney's Office in New York charged 2 employees of the company of illegally exporting billions of dollars in NVIDIA chips to China. The indictment unsealed on Friday named Wally Liao, co-founder and senior VP of development, and Stephen Chang, a sales manager there at the company, in the case. Liao is also a board member and holds $464 million worth of SMCI stock. And digging through this, the investigation uncovered a sophisticated strategy using a middleman company in Southeast Asia to compile fake paperwork and a separate logistics firm to repackage those servers to conceal them before going to China. Then the defendants used dummy servers in storage facilities and then pressured the compliance team to approve those shipments. Now understand, I am not letting CEO Liang and the rest of management off the hook here. Even though looking through this indictment, it doesn't look like other management was involved and SMCI wasn't named as a defendant, it still is a very bad look for top management, and there likely could have been other export controls in place to catch this sooner. Now, SMCI has released a statement and fired the employees, as well as having cooperated with authorities in that investigation. We don't know yet if the government is going to try to fine SMCI for its export controls, but it is not out of the question. Nation, I've said several times that this is a roller coaster stock and not for short term investors that get scared out on the drops. I've been buying since the stock dropped to $18 a share late 2024 on those delisting fears and have recommended it generally between $30 and $40 a share. Management has dropped the ball several times and there's no excuse for it, but the fact remains that this is still the top server maker in a market that is booming on that AI data center buildout. On as much as $1 trillion in AI spending this year, SMCI is expected to grow revenue by 88% to $41.5 billion and to capture up to a third of that AI server market. Earnings growth is sluggish, but still expected 8% higher to $2.25 a share. That growth helped the company deliver its largest beat on revenue in 3 years, reporting Q2 growth of 123% to $12.7 billion for the quarter. The stock popped 14% on that news in early February and was actually up versus the market sell-off until this shit show we saw on Friday. More than that growth, though, is the prospect that profitability could be improving on the company's Data Center Building Block Solutions, the DCBBS program, to help companies build and deploy AI infrastructure faster. The program is a one-stop concierge service for setting up a center and, importantly, is higher margin than the company's standalone server sales. In the most recent earnings report, management guided the DCBBS program to double-digit contribution to profits by the end of the current fiscal year, which ends here in June. With a contribution of just 4% to profits in the most recent quarter, that means a significant increase over the next 6 months. That's important because the biggest overhang in the shares, besides the piss-poor management, has been the profitability, with the gross margin lower by 5.5% over the last year. So any improvement here with the margins would go a long way to improving the outlook. The company also announced in February a partnership with Fast Data to launch the C-Node X solution, integrated and rapidly deployable AI data platform as a ready-to-run solution. This type of packaged solution is also going to be a higher margin product and put some of those earnings growth fears to rest. All this brings us back to the valuation, though. On Friday's close to $20.53 per share and a market cap of $12.3 billion, the stock is trading for just 0.3 times on a price-to-revenue basis and just 9 times price-to-earnings. Nation, that is the lowest I've ever seen it, even during the delisting scare a few years ago. Morningstar data here shows the shares down as low as 0.37 times price to sales and 15.7 times price to earnings in that 2019, but the 5-year average has hovered around 0.94 times sales and an 18x PE ratio. This is a company growing sales by 88% a year with a reason to believe it can boost profitability that is trading for a 70% discount to its average multiples. Now, Friday's plunging stock price sucks. I know I'm right there with you holding the shares. And again, it's another instance of management dropping the ball. But the valuation and the growth on this company is something I just can't ignore. At this point and this valuation, I wish private equity or just an activist investor would just come in and force management to get its act together. But until that happens, I'm going to hold on because this stock is worth much more. It's not an easy ride, but for patient investors, I continue to believe this is going to be a very profitable one. Now, beyond SMCI, Nation, understand I am not going to just sit here and regurgitate the same stocks you see everywhere else. I could sit here and only talk about the easy and safe stocks like those trillion-dollar tech giants. YouTubers love to recommend the bellwethers like Nvidia, Amazon, Meta, and Apple because, well, hell, everyone owns them already. They're safe, and if they do lose money, you're not going to remember who talked about it anyway. But then I'm not providing you any value if I'm just talking about the same stocks as everyone else. And it's not those stocks I hear you ask about in the comments. That's stocks like SoFi Technology, ticker SOFI, up 240% since I started recommending it in 2022 when it was just a $5 a share stock. Or Symbotic, SYM, up more than double from where we started following it in 2024. Understand, in these kinds of high-risk, high-return stocks, you've got to look at it at a portfolio level. You're going to have some turds like SMCI, but you'll also have those 2 and 3 baggers like SoFi, Symbotic, and Broadcom. Even when the shit hits the fan, though, revisit your analysis, and if it says hold tight, then Have the patience, and even the dogs like SMCI can have their day. One of the safer stocks that did catch my eye last week, Energy, ticker NRG, beating the market trend to close 6% higher last week and is now up 61% over the last year. I included the utilities provider in our video Friday on the 10 stocks I'm buying to replace the Vanguard VOO index, so check out that video linked in the description. Thanks to its growth to 25 gigawatts in capacity and a strong focus on natural gas, the company has grown sales by 9% over the past year and is expected to post runaway 14% growth this year. That is more than twice the 6.8% average revenue growth seen across the utility sector, and earnings are also expected up almost 13% to $9.28 a share. Folks, electricity generation is the big bottleneck in AI growth, and Energy is aggressively adding capacity to meet that through building and acquisitions. And surprisingly here, even after a 60% run, shares still aren't too expensive, trading at about 1 time sales and about 17 times this year's expected earnings. Now, updating our market outlook, there's almost nothing in the way of economic data or earnings news this week. That means investors are going to be singularly focused on the war in Iran. It's likely to get worse before it gets better. Iran continues to strike oil assets in the Gulf, and despite the loss of key leadership last week, looks no closer to capitulation. The Trump administration also floated a $200 billion supplemental funding bill to cover the additional cost to operations, on top of the Pentagon's $1 trillion annual budget. Nation, I've been warning of the current weakness over the last couple of months, with the S&P 500 now closing lower 4 weeks in a row, and believe we still have at least a few weeks to go in that correction. The market index is now down 7% from its January peak of 7,002, and we could still hit that 10% lower territory to 6,300, maybe even a little lower if boots hit the ground in Iran. Again though, despite that near-term weakness, this does not look like the start of a bear market. Earnings growth was 13% in the fourth quarter and is expected at 12.5% for the first quarter when those earnings start coming out in late April. With tax changes coming through, earnings growth is expected to accelerate to over 18% for the second half of the year, a very strong pace that should support stocks. And here, while the price-to-earnings ratio of 20 times expected earnings is higher than that longer-term average of 18.9 times valuation, it's only a 7% premium, so not bubble territory that would beg for a sell-off. This current sell-off is all geopolitical risks, and while I do expect the war to continue longer than expected and for it to pull stocks lower over the next few weeks at least, this is still a buying opportunity for long-term investors. I know it's hard watching stocks fall, but this is the opportunity investors always say they want, to pick up those shares at a cheaper price. Take it and hold on, because the one certainty is that stocks will always recover, and this year could still be very good for investors. Look for the link below and try Seeking Alpha Premium risk-free for 7 days and get $30 off your subscription. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.